Hello everyone, welcome to my channel. Today I'm going to talk about maximize your tax savings, the importance of keeping home improvement records before selling your home. Let's get into the video. Many taxpayers do not feel the need to keep home improvement records, thinking the potential gain when they sell their home will never exceed the amount of the tax code's execution for home gains explained during this video. Under the current version of the tax code, you are allowed to exclude from your income up to 250,000, 500,000 for married couples of gain from the sale of your primary residence if you own and lived in it for at least 2 years, 24 months of the 5 years before the sale. You also cannot have previously taken a home sale exclusion within the 2 years immediately preceding the sale. There is no limit on the number of times you can use the exclusion if you meet these time requirements. However, extenuating circumstances can reduce the amount of the exclusion. The home sale gain exclusion only applies to your main home, not to a second home or a rental property. As mentioned earlier, you must have used and owned the home for 2 out of the 5 years immediately preceding the sale. The years you do not have to be consecutive or the closest of the sale date. Vacations, short absences, and short rental periods do not reduce the use period. If you are married to qualify for the 500,000 exclusion, both you and your spouse must have used the home for 2 out of 5 years prior to the sale. But only one of you needs to meet the ownership requirement. When only one spouse in a married couple qualifies, the maximum exclusion is limited to 250,000 instead of 500,000. If you do not meet the ownership and use requirement, there are some situations in which a prorated exclusion amount may be possible. An example of this situation would be if you were required to sell the home because of extenuated circumstances such as job-related move, a health crisis, or other unforeseen events. Another rule extends the 5-year period to account for the deployment of military members and certain other government employees. But what if your home sale gain is more than the home sale exclusion? Then it's your best interest to have kept home improvement records, since the cost of improvement can be added to the purchase price of the home to be used in determining the gain. So keeping the receipts for the improvement, even if only in a folder or a shoebox, may be useful in the future when you sell your home. Here are some situations when having home improvement records could save taxes. 1. The home is owned for a long period of time, and the combination of appreciation in value due to inflation improvements exceed the exclusion amount. 2. The home is converted to a rental property, and the cost and improvements of the home are needed to establish the depreciable basis of the property. 3. The home is converted to a second residence, and the exclusion might not apply to the sale. 4. You suffer a casualty loss and retain the home after making repairs. The home is sold before meeting the 2-year use and ownership requirements. 6. The home only qualifies for a reduced exclusion because the home is sold before meeting the 2-year use and ownership requirements. 7. One spouse retains the home after a divorce and is only entitled to a 250,000 exclusion instead of the 500,000 exclusion available to married couples. The eighth thing is there are future tax law changes that could affect the exclusion amounts. Everyone hates to keep records, but consider the consequences if you have a gain and a portion of it cannot be excluded. You will be hit with a capital gains, and there is a good chance the capital gain tax rate will be higher than the normal simply because the gain pushed you into a higher capital gain tax bracket. Before deciding not to keep records, carefully consider the potential of having a gain more than the exclusion amount. Home improvement include just about anything that will increase the value of the home, from big ticket items like remodeling a kitchen, adding another room or a swimming pool, and landscaping to the smaller items like ceiling fans. But there are some home improvements that cannot be included in the cost of home improvements or may be only partly included. Examples are items which qualify for tax credits such as home solar, home energy efficient improvement, or those that qualify for a tax deduction such as handicap improvements. In addition, the cost of general maintenance or repairs, such as fixing leaks, painting interior or exterior, and replacing broken hardware, do not count as improvements. If you have questions related to the home gain exclusion or questions about how keeping home improvement records might directly affect you, please contact a tax professional. Thanks for watching this video and do not forget to subscribe to my channel.